Welcome to the Cash Flow Project Podcast. Are you looking to better your financial situation by increasing your cash flow? Too busy to hunt for real estate deals or don't know where to start? Then you're in the right spot. Join us as we dive in and talk about investing for cash flow using multifamily real estate.
Welcome to the Cash Flow Project. I'm your host, Matt Callahan with Tri-City Equity Group. With me is my co-host, Vince Gethings. And today we have a special guest with us, Sam Bays. Sam's a principal of Trinity Capital Group and the owner of Paradigm Real Estate Investments. Sam's background is in financial services, state and local taxes, and real estate. He's been directly involved in the acquisition, rehabilitation, and management of over $40 million in multifamily and single-family assets since 2009. Sam spent 10 years in corporate America, where he honed his business acumen and developed many characteristics that help him succeed in the real estate industry. He started at UBS Financial Services, where he cultivated his knowledge about financial markets. He directly worked with advisors that had over $3 billion with a B in assets under management. After graduate school, he transitioned his career to state and local taxes. And during his tax career, he helped companies save more than $45 million in taxes. Sam graduated from Texas A&M University with a bachelor's in finance, a master's in personal financial planning, and his MBA from Texas Tech University. Sam's an avid reader, sports fan, and loves the outdoors. He attends Motor Place Church. Sam, welcome to the show.
Thanks, Matt. That was a great introduction, and it made me realize I need to update it. Now I'm at about $100 million in assets under management, but everything else holds true. So it's a pleasure to be on your show, and looking forward to talking to you and Vince.
Yeah, we're glad to have you. That's quite a big update there. We're only $60 million off or so.
Yeah, that was probably my mistake on not updating it in the last couple of years.
No worries. It sounds like you've been busy though.
Yeah, definitely. It's been a whirlwind the last 4 years, and I think it's just we're starting to finally build and have some puzzles or pieces in place, and I think we're looking for even more rapid growth in the next few years.
Excellent. Well, we'll definitely make sure that we're talking about that here soon. But I'm curious. It sounds like you've got a lot of formal education, which not everybody does in the real estate space. When you started, looking into the financial space with your degrees, was real estate even on the radar at that point?
Real estate's always been kind of on the forefront. I actually thought I was going to get my master's in real estate after undergrad. And then I worked or interned at UBS for a summer just to gain some experience, and they offered me a full-time position. And at that time, the market was going up, and it was like 05, 06. I was out in LA, Beverly Hills, and kind of was indoctrinated into a great life. And I was like, I might as well enjoy it. I'm 21, 22. LA can be a lot of fun, especially when you know the right people and have some connections. So I definitely love my time out there. But I realized LA wasn't going to be my forever home. I wanted to move back to Texas. And my grandpa, he had always pushed me to get my master's, and I decided to get my master's. And I mainly went to get in personal financial planning because I thought at that point I was going to just be an advisor and help clients save for retirement or meet their goals through the traditional investment, stocks, bonds, mutual funds. So I went and got my master's, and then they had a joint MBA program. But during that time is when the market crashed, and I realized I couldn't approach a person and have them invest with me or through me and not be able to control any aspect of the market, how it moves, where it's going. I mean, if a CEO at Coke or just some Fortune 500 company does one thing, the market and that stock could crash. Or if the markets in Asia do one thing, it completely impacts the U.S. market. And I didn't want to be a part of that. So I started to get back in reading real estate and read quite a few books. And then I was at a consulting job that I didn't really enjoy, and that basically helped me catapult into real estate because I didn't want to be in a consulting job for 30, 40 years, then retire on a beach somewhere. And the more I read about real estate, the more I learned, the more I felt like it fit my skill set and specialty. And also I could help people save for their retirements like I've always wanted to when I had my finance degree. It's just using a different type of vehicle and an alternative investment that I honestly think is better than a stock or mutual fund.
No, I couldn't agree with you more. And it's something you touched on that I love is you could do all the research think you know everything about a company, how they're going to perform, where they're projected, and overnight some scandal from the CEO, hits the headlines of the news, and all your money's gone.
Yep, that's my story, Matt. Right?
I know. I was going to say you teed it up for Vince, and I was going to let him tell it.
Yeah, it teed up for me. So I was big into stock investing early on. So military, when you're deployed, you get bored. So that's like a good hobby to have when you're deployed or TDY with all the extra money you're making is the stock investing. So I got into like stock investing, swing trading, and then I got found the Benjamin Graham book. So I started getting into value investing, and then I thought it was pretty good. And then there was this one company I studied for months in green energy, and I was like, okay, I pulled the trigger, and then a couple quarters, and I was like, kind of okay. Like green energy was back then, very very heavily subsidized, and then by the government, and then like it was like Q3 earnings came out, and everybody was just like, this isn't adding up, and then people started going to investigation mode. And then it found out the CEO and CFO were submitting false documents to the shareholders and to the SEC. And that was just, at that point, I liquidated my brokerage accounts, my IRA, everything, like my TSP, which is the government's version of a 401k. And I was done. And I was like, I need to find something else that I have control over, because it was just months and months and months of doing all the right things, doing all the right checks. And still, it was the CEO and CFO were just frauds. Essentially, and you realize you actually have no control over anything, right? There's still some suit somewhere on Wall Street or something that's pulling the strings, and you have no control over that investment. So pulled everything out, and I found something. I was looking for something else, found real estate. Like, sounds like kind of what you did as well.
Yeah. Sorry you went through that, but it's great that you were able to pivot and took massive actions in other directions, and still wanted to felt like you were responsible for your own financial future. And I've known a lot of people that will invest in the market, and when it goes down, they say it's not for them. So then they put their money in CDs or savings accounts, and they think it's a safe investment, but it's not. They're losing money, especially with this year and last year, and how the Feds pumped the economy full of stimulus. They're definitely losing money with inflation. So.
Exactly. Yeah. And I think for me, my saving grace in that story was I was just young. I was 25 years old, so I had the time to recover. But there's a lot of people that don't, right? And they're only things like, well, I got to go back to work, right? It's like messed up, right? So that was pretty much my only saving grace, that I just had youth on my side.
Yeah. That's awesome.
So I'm curious, coming from a financial background, you were at UBS. As you transition to real estate, did you get any pushback from some of your peers that are, stuck in their ways of the traditional stocks, bonds, other securities like that?
I didn't really get pushback from any of my peers. Like, it's weird. The first consulting firm that I worked at, I had 4 or 5 lifelong friends that I've had now for 12 years. And they were always listening to what I said, but they really didn't really believe that I'd do it. And I talked to my parents and my granddad a lot, and they were the ones that gave me pushback. And it's weird because my grandpa, he owned his own business for forever. My dad, who was a farmer, so he's essentially an entrepreneur and relied on himself, but they thought it was too risky for me. And I honestly listened to him for a couple of years. And then I got to the point where I just had to find a better way out to save money and hopefully get out of the rat race or corporate America or whatever you want to say, because I was working 50 to 70 hours depending on the week consistently, and it was just draining. And I knew that there had to be a better way where I still might work that amount now, but it's at least for myself and my business, and I enjoy it compared to I was studying tax code and oil and gas dictionaries on learning how pieces of equipment work, which, I mean, it's great for a short time, but doing it for months on end or years on end does not sound appealing to me.
Yeah, real exhilarating stuff there.
Yeah.
I have a similar situation. I've just got buddies that are real big into the stock market, and I always talk about my deals, and they're like, well, XYZ, that's probably a code for some company. This company has gone up, 18%, blah, blah, blah. And I'm like, man, you're making hundreds of dollars. Congratulations.
Yeah.
And we just give each other a hard time. But if he's listening to this, he's actually, he's like, let me know when you get the next deal. I guess he talked to his father-in-law, and he's realized what's what.
Yeah, it is interesting. Like all the friends and family that I've talked to, they've realized how my life, I think, changed just from being in a corporate job to now having that freedom. And they've all invested with me in projects. And I think I have lifelong investors, and or I assume I have lifelong investors. So they definitely have seen the impact real estate can have, and especially from a land development, if you take raw dirt and build it out, you can create so much value that it's almost impossible to do with stocks or crypto or something like that. And I know crypto is really big right now, and it's a buzzword. And yes, you have the massive upswings, but you also have the massive volatility where, like Corona, when the market dropped 30-40%, our real estate price didn't change at all. And in fact, our pricing probably on our assets have went up.
Yeah, ours have gone up.
Well, so that's something we wanted to dive a little deeper into. You're talking about taking raw dirt and transitioning to an asset. You've got quite a bit of experience with new development, which is something that a lot of our listeners might not be too familiar with. You want to talk us through maybe the last deal you did and kind of how that looked?
Yeah, the last deal, I guess it's a continuation of a deal, or I'll go to one that's now stabilized, because we have one development project we're about to start leasing up, but we just finished stabilizing one at the end of November. So that one, it was outside the city, so we didn't have to go through all the planning and zoning that you typically have to do with a new construction deal. And we find value where we go into the land, and we can buy it zone multifamily, but if you buy it zone multifamily, a lot of the value is already extracted, and probably the previous owner, the developer who came in to zone it multifamily, they took a portion out of the price. So we always look for land that's not zone multifamily, and we'll go through planning and zoning with the city or the county or ETJ or whatever jurisdiction has control of it. And depending on the location, that can take months or it can take years. Like this property that we're going to start leasing up in February, we've been working on it since 2017. And it just took forever to get through that process. But with this one specifically, that city was a lot easier. So we went through the planning, zoning, and platting process for about 9 months. And then we started the build process. And I'm not the builder on it. One of my partners, he actually has 20 to 30 years of construction background experience, and he handles actual development or the build out of the projects. But it's very rewarding taking raw land and turning it into a tangible product. And we typically build in secondary or tertiary markets. So we try to find areas that have a large demand but no supply. And so far, we've been successful with that. And honestly, we've always gotten third-party reports from different consulting companies to show if there's a demand or not. And this one, I was calling up some of the vendors we typically use, and they're like, that area was so small, they didn't have data to provide. So that was a little nerve-wracking. But for this project, we did a joint venture. It was only myself and my two partners and one other family who has a lot of trust in us, and they've done several projects with us. So we felt like it was worth taking, and we developed a 48 unit. It was essentially a townhome complex. And throughout the lease up, I mean, our rates, we started at $1,400 or so a month. And we thought if we got that, that'd be great. And we ended up at some of the rental rates are at $1,650. So we knew there was going to be some demand. We just didn't know how much. And our break-even analysis showed if we could just stay 60% full, we'd turn a profit. So now we're at 96 to 98%. And I think it's going to be a great deal. Now that we're stabilized, we're going to start the refi process, and we'll probably return 120% or so of the initial investment back to our investor and ourselves. And then it's just kind of a rinse and repeat model.
Yeah. Wow. That's in Dallas?
It's outside of Fort Worth, like 30 minutes northwest of Fort Worth.
Okay. How many units?
48. It's one of our smallest developments, but the city itself has a population of like 5,000. So we knew we couldn't do a large development.
Okay. Those are like A-class, high finish.
Yeah, high finish. We have some connections over in Asia. So we've started importing, I guess in 2018, we started importing almost all of our materials, our light fixtures, our custom cabinets, quartz counters, flooring, pretty much everything that goes on the interior of an apartment except the appliances we're importing.
So I've got a question kind of walking through this whole model. I know when we do our underwriting for our deals, we obviously have, hard data, rent rolls, stuff like that. You're just literally finding a piece of ground. So what's your market research kind of look like, and how is it different than a traditional model whenever you're literally starting from ground up?
It's pretty similar to acquisitions. Luckily, I have Daniel, who's one of my partners, who has 20 to 30 years of data, and he knows his cost to a T. Labor's starting to fluctuate, and labor really the last year or two's went up, and then lumber's went up, but everything else he can pretty much tell me spot on what to put in the models, and we can build out. And from like a cost or purchase standpoint, I'll put all that in. I'll put in the land cost, and then do a pretty rough estimate on the soft costs, such as architecture, engineering, and some of the other fees associated with that. But the rental rates, it is tough. With some of our larger projects, like we're building, the one we're opening in next month is 252 units. So with that, we had the information and we had data, and the third parties could provide us what they thought leases were going to be. And then there's enough properties in that market where I can look and do comps just like you would on acquisition. So you can get pretty close to what you think your market rent's going to be. But figuring out your other income and expenses, that's a little bit tougher. We're getting better the more we've done it. But looking back, our first deal we underwrote, it was a mixed use development, and looking at the cost that we underwrote for that deal versus what it truly turned out to be was really bad, and it was night and day. But we luckily overshot significantly. So we were using kind of the rule of thumb, like the expenses will be 50%. Well, with a brand new Class A property, I mean, our average expense ratios now, depending on the location and taxes, is probably 28 to 35%. So luckily we were on the better side of that. But now, and we've honed in where we've created a couple of really good relationships with property managers, and depending on who's going to manage it for us, we'll talk to them. And one is great with new developments and lease ups, and they can give us a pretty accurate idea of what they can run it for. And that also helps with underwriting to get second eyes and opinion.
Now, I guess all that makes sense. Now, something that's kind of interesting to me or that I've been wanting to know is, like, what are the different finance options? You said a project can take years before you're making any money. Yeah. How do you float those carrying costs, or what are some different ways that you've used, or what's your preferred way?
Yeah, we've always pretty much had the same type of financing. We've done construction loans with just different banking relationships we've made over the years. I think going forward, we'll probably try to add mezzanine debt or pref equity, or there's a program called PACE financing where it just helps you leverage up, because with construction financing, we were getting LTC at anywhere from 65 to 70%, depending on the project. So if we can add those other financing options, we can lever it up to 80 or 85% and just increase the returns that much more. And over our projects, we've learned that I think going forward, we want to structure it a little differently, where, especially with the syndications, we'll raise all the equity, we'll close the loan, and then you're right, you might not get cash flow for 2 or 3 years. And so some of our investors completely understand that, and they're looking for the long term. But people who've invested in syndications and they start getting cash flow at year 1 or 6 months or whatever into the deal, they are a little more nervous, and some of them have asked us, oh, well, why haven't we got it here? Why we haven't got it there? And it's like, well, you have to have tenants to make money. I think going forward, and we've done this on our small projects, but on the large projects, we just can't finance it. And now we might be at a point where we can go in and do all the horizontal construction, which means the roads, putting in the utility infrastructure, building out kind of just a base, and then getting the architecture, engineering, all the project or all the professional services completed. And then we'd raise the equity and close. And I think that would speed up the process, where maybe you go from 3 years of no cash flow to 18 months or something like that. And it would juice the returns for the investors. And we would also be able to get a little cut from all our work on the horizontal costs or horizontal construction, and then sell it to them as more of a package deal than from what we have done in the past.
Okay, that's interesting. So front the cost, lay the groundwork, everything that takes time, you're going to head and do that before you present it to any investors. And then when it's ready to build, you bring them in, they hang on through construction, you fill it. Am I understand that right?
Yes. And like, we were looking at one piece of land about an hour north of Dallas. We passed on, but we were going to be buying it from a developer whose sole business model was doing that. He would take the raw land, he would go through the zoning, he would put in the horizontal construction, then he'd sell it. And he wanted to partner with us, but we just couldn't get the numbers to work. He was wanting a significant we thought, for price per square foot. And we just decided to pass. But like, one of the developments we've done, we've actually decided to sell to a REIT, because we bought it and we were planning on building like an 84 unit complex. And we had a REIT come in and they were like, we need land, we need the horizontal construction done. And we bought it, and they were going to pay us basically 1.6 million more than what we bought it for after we put in the horizontal construction. So we're like, I wanted to hold it and build it out. But our investors and ourselves, we thought it was too good of a deal to pass up. And we weren't having to take on the risk of another 12 to 18 months of actually the build process.
Well, so it sounds like a lot of wins for you. Do you have, any major failure or a favorite failure? What's the downside of what you're doing?
Yeah. Probably the biggest failure I've had wasn't in a development, it was in an acquisition. And we bought an apartment in September of 2019, and I brought in a third-party management company that we had used in the past, and they'd done a great job at this other property, but they were new to this market. The market was strictly like the property we took over or bought was 86% military. So it's almost all military. It's a military town. And we came in, and in October through December, there was 3 deployments. And we went from like, when we got it under contract, it was at 99%. When we closed, it was at 92%. And by January, it was at like 65%. We've invested in other military towns, but we've never had that big a occupancy fluctuation. So I kind of just listened to them for a couple months and believe that is all based off the deployments. And then I went to a conference and I was talking to a couple of people who actually invested in that market. And they're like, well, we're at 85%. I'm like, well, why are we at 65? And I quickly realized it was the on-site manager. And the very first time I met her, I had a gut feeling she wasn't going to be able to handle it. And I should have went with that gut feeling, because she couldn't. And she would tell us one thing, and a lot of it was covering her tracks. After I talked to a few people and realized where they were at, we fired the management company and brought in a new management company. And it took a few months, but we hit that 90%, then jumped up to 95, and now we're at like 92 or something. And I learned that was a big mistake. I should have went with my gut. And there were signs during the deployment that I should have made a change at that point, but we just listened to them. We trusted them. I think from their other from my experience with the other apartment, I gave them too much credit and they just didn't know that market. And I should have made a decision a lot swifter and quicker to fire them.
Wow. So they weren't local then.
No, they were, it's a large company. They manage over $1 billion of assets and they're based in San Antonio and the apartment was in Killeen. So it was a few hours away.
Army bases.
Yeah.
Go to Air Force Base, no problem.
I will say we have apartments in Army and Air Force towns, and the Air Force towns, it's a lot easier, but there's less deployment.
Yeah,
that's true. That's because their deployments, they get you get that TUI money. They're at 5-star resorts. And
I got so many. It's crazy.
That's interesting because I don't know if maybe Vince, you and I just hadn't talked about it, but I've never considered like checking patch charts for deployments in some of these. El Paso is one of our big markets, military base. And I never even considered like, granted, we're not at, huge full scale operations right now, but if like a division deployed, what would that do to our tenant base? Because we've just kind of been taking a look at, which tenants were essential as COVID, obviously. Vince will probably talk a little bit about that, but who's essential and something that we like about military is like they're getting paid on the 1st and the 15th, but if they all pack up and go somewhere, it doesn't matter if they're getting paid because they don't need a place to stay anymore. I hadn't even thought about that.
Yeah. And that might've been just one anomaly because luckily through that entire process, the owner we bought it from, they're based in Dallas and they built their dad built it in 96. So they've treated it like a baby and we've kept a really great relationship and I'd rely on them. And I talked to some other people in the market and they were like, that was by far the worst deployment we'd ever seen. So, and right now we're going through another deployment and we're staying above 90. So I think it was just a large deployment over 3 months, all hit at once. And the staff and team we had in place, they just couldn't handle it. But I think if we would have had our current property manager in, we would have been able to weather the storm a lot better. They're a lot more proactive and aggressive in leasing and actually do what a property manager should do.
Absolutely. And we're making a shift as well in our company as far as what indicators we track. And a lot of people do like, everybody has their KPI sheets and tear sheets and one pages that they get from the property manager. But a lot of them are lagging indicators like, okay, how much rent did we collect? What's the owner statement for this year, the P&L? Like those are all things that happened in the past. So now we're shifting more to a leading indicator model where it's like, how many notices to vacate did you get this week and why? Right. So if we get, 4 notices to vacate because Fort Bliss is, gearing up for deployment. Now we have, some lead time. We got 3-4 weeks to like ramp up, marketing and things like that, rather than wait till the unit's empty, turn it, and then ramp up, marketing, because that would be, again, a lagging indicator would be a report of, how many vacancies do we have, right? Well, it's like, that doesn't help. They're already gone. Like, let's get them before they leave and see if we can get them pre-leased. So let's look forward and solve these problems ahead of time. So that's a new model that we're doing heavily into this Q1 and Q2 this year. Is shifting into that and hopefully solve some of those problems where we can catch those things like a deployment coming up or like, maybe plants closing down and it wasn't in the newspaper yet because, nobody wants anybody to know. That is awesome.
Or Sam, are those properties, they're all in Killeen? You've got multiple units there in Killeen?
We have one property in Killeen and it's 137 units. It's going to be a great asset, I think, for the long term. We suffered a hiccup in the first year of operations, but there's a good, strong rental base. The property and the location it's by far the best in that little niche or submarket. So I think we'll do well. The broker that sold it to us, they've given us a BOV and we've already increased the project by roughly $3 million. I think just because where rates are, where cap rates are, and then also we've renovated roughly 70% of the units right now. And the lowest ROI on each unit type we're getting is probably a 17 to 18%. And some of the unit types were getting 25 to 30. So there's definitely a demand where we went in to upgrade units. That market is starting to see a lot of renovated units, but when we got in there, that market really hadn't seen anything. So it was like the bones of the project was good, or property was good, but it was definitely 96. You could see where everything looked like it was in the 90s.
Yeah. So you like the market though, it sounds like.
Yes, I do. I was always hesitant on clean, honestly. And then we have a property in Wichita Falls that's Air Force, and it's performed really well. And that kind of opened my eyes up to more military markets. And I think obviously you have to buy it right, but we're looking at another property in Killeen right now. If we can agree to terms and pricing, we're going to take it down. It's roughly 200 units.
I'm going to give you a tip here, maybe side project if you're bored one day. So Shepherd Air Force Base in Wichita Falls, right? It's a big training base, or in any other training base. So there's this thing called the JTR, Joint Travel Regulation. And in it, there's something that you may be able to, niche into for a business plan. And if there's people that are in training long enough and they're not like young, like they're not a pipeline student. So you're 18, 19-year-old, just joined the military. A lot of people go back to bases like Shepherd Air Force Base and Army similar to go back for follow-up training. They can go for 6 months, a year, something like that. And they have the opportunity to either stay on base in like barracks or stay off base in an apartment and get their funding and everything like that, their normal BAH and allowances. So there's this niche that I've seen a colleague of mine that was in the military. He was like, I'm going to create a business model about this, is going to these training bases and developing like fully furnished type apartments for those people that are coming back to training bases for like a year or something like that for following training. Shepherd Air Force Base has a lot of pilots and stuff like that. So you're going to get a bunch of younger lieutenants that are just looking, they don't want to be on base in barracks because they're, that's lame. So they're looking for some kind of fully furnished apartment that they can get. So there's definitely a niche there for that. Maybe section off maybe like 5 or 10 units if they're nicer, furnish them or make them nicer, furnish them, and then market for those type of people. Would be
I'm really glad you said that. And I want to talk to you more about that. We've actually done that at our property, but it's been with the Netherlands Department of Defense. And I didn't know it from the U.S. standpoint, so I'd love to talk to you more about that. But we had 5 corporate suites that we'd rent out to the Netherlands, and when they brought over their pilots to train, and I was talking to their commander, and he said if they're married, they can stay off base. If they aren't married, they have to stay on base. And we were getting phenomenal rent rates. And then I think they realized if they didn't pay for a furnished apartment, our monthly rent for 2 bedrooms like $935 to $950, and we're charging them $2250. And I guess it was last year sometime they were like, we aren't going to do any more furnished, and we found out they hired a company or rented furniture from a company, and they just furnished it themselves. So I would love to talk more and see if we can create that again now for the U.S. Air Force.
Yeah, absolutely. Matt, you got any other questions?
Well, I was going to ask one more, but it seemed like a natural transition. All right. Last one. Sam, what would you give? What advice would you give to your 20-year-old self, and what were you doing at that time? Sounds like you were probably at A&M.
Yeah, at that time, I was just told, go get a good education, get a good job, and just stay there forever. I think if I could speak to my 20-year-old self, I'd say the people you surround yourself with are key. You always hear the 5 people that you surround yourself is who you become. And I think networking is instrumental. And also just become a voracious learner and try to learn as much as possible. I always studied and learned textbook material, but the last 4 to 5 years, I've started to learn or go down like self-growth, self-development, psychology, just to make myself a lot better of a person. And it's paid huge dividends. That and my building out my network. I mean, especially if you're in sales or real estate or whatever, where your network is vital and important. The more people you know, you're just going to have much more success in your career and endeavors.
Yeah, I couldn't agree more. And like Grant Cardone says, it doesn't matter what industry you're in sales.
Yep.
Yeah.
And
I always thought sales was a negative word, and I still don't want to think I'm in sales, but I am.
Yeah.
You're selling yourself every day.
Sam Bates.
Yeah.
Exactly. Yeah.
All right. Well, Vince is probably he's taking his notes. He's prepared a couple of questions. I'm going to pass it over to Vince.
No, you've asked literally everything I wrote down. But anyway.
All right. Well, we'll see you next time. And
improvising here. So no, to the point of your 20-year-old self coming, right? If you look at the people you're around. So one of the quotes that I always, ascribe to that. And I realized that some of the people that I was hanging out with weren't the best. So I completely understand. And it's not the paradigm shift you have to have is not that because people don't want to turn their back on their friends, especially or their family, right? Because sometimes you have family members that are just not, inspirational or whatever, pushing you toward your goals or aspirations. So people don't want to do that. They don't want to offend them. They don't want to make them feel bad. So one of the things I read was I had a mentor that gave me a book, and he was like, "Don't think you're turning your back on them. You're still here. Like, I'm still facing you. I still love you, and I'm still here for you. But I'm just going to back up this way and kind of do my thing that way. But call me. I'm always going to be here for you. But I need to do my own thing." So that was kind of a good paradigm shift. And then the last one was, one of those random, Instagram quote cards I saw from Nipsey Hussle was a spin on that same thing was, if you look at the people in your circle and you don't get inspired, then you don't have a circle, you have a cage. And that was like, that hit me like a ton of bricks, because I was like, man, that couldn't be truer, today. So that's when I was like, okay, I'm going to really make a conscious effort to separate myself and then go seek those groups of people that are operating at a higher level or operating where I want to be. So I completely understand where you're coming from on that. Let me see here. So I want to, before I move on to the next kind of topic, is there any good education programs? I know you have a lot of your stuff was college related in your internships and early jobs, but for somebody looking to get into new development now, what education programs, resources, books, checklists, or anything that could help them get started?
I think now real estate, I don't know if it's because social media, podcasts, whatever, over the last 5 years, I feel like educational programs have just blown up and exploded. Back in 2009, I did join a mentorship program in Dallas that was focused on BC class properties, and I learned quite a bit from it. As I evolved and as I evolved and progressed, I realized what they wanted to sell and do didn't really help me, or our ideas just didn't align. Like, they definitely spoke down on development and new builds, which I think there's a place definitely for it. And I never took any type of educational programs or read any development books, so I don't know if I can really speak into that. But I mean, I listen to podcasts on real estate all the time. There's probably 20 to 30 different podcasts I listen to. So if somebody's wanting to take that step and learn about real estate or learn about investing, either podcast or there's a lot of great books out there too. One of the books I read was Sam Zell. It doesn't get into like specifics on how to do it, but it's just a very inspirational story. And I'd love to be at his level one day. And there's some other commercial real estate books that I've read over the years. One's by Brian H. Murray. I can't think of the name of it, but it's a good introduction. Yeah, I think it's Crushing It. It's a good introductory book into commercial real estate.
Okay, nothing like on new development specifically.
I haven't read anything on new development specifically. All
right. Let's see here for tax breaks. Do you try to target any kind of like tax breaks with new development? I know I read a couple of years ago that was kind of a thing that you could do is, negotiate with, Chamber of Commerce and things like that, and the Office of the Mayor to try to get a, tax break on, or at least a deferment or something. on new development projects? Are you doing things like that?
We've tried to with a couple different cities, but there's such a demand that they really don't have to give tax breaks, especially if it's conventional housing. Maybe if it was tax credit housing, obviously they're going to give tax breaks. But one good thing for us that we are investing in smaller secondary and tertiary markets, I should knock on wood, at least so far, they've been less aggressive on their property taxes than most of the large cities and counties that we deal with. For instance, we built a property and started in 16 and it came to market in 18. They have it valued at like 1.3 million less than what it cost us to build. So we're still having to pay that yearly property tax, but we haven't had the values skyrocket. So we're still at a very low basis, and we fight them every year, and we've actually won almost every year. And but going forward, we're looking at all different types of tax credits we can get, whether it's property or just some other incentives that boost the bottom line.
Yeah, absolutely. And I was going to ask about that. In your bio said you helped people fight taxes. Are you doing that now, or are you hiring a lawyer like we are for taxes?
Yeah, that was more so in my corporate days. I've worked with property tax, and I can do property tax valuation, but it's not my best value and best time, I think. So we hire third-party property tax consultants, and then if we have to go to litigation, we'll bring in attorneys.
Got it. All right. So we're recording this, January 2021. We're about like 9 months into COVID. So kind of walk us through, beginning of 2020 through COVID, what things occurred, good, bad, how, and more importantly, how did you change your underwriting and your operating of your, certain properties through COVID, and then how are they performing?
Luckily, pretty much across the board, our portfolio hasn't been impacted significantly with COVID. We have one property in the Memphis MSA. It's been impacted the most, but we're still collecting on average probably 94 to 96% of rents. But our third-party property management companies and us have become a lot more proactive. We're sharing a lot more resources with tenants on how they can get help, whether it's through government funding, charities, different things to make sure that they're staying afloat and being able to pay their bills. Obviously, that hasn't happened to 100% of the residents, and depend on the city and the state that we're operating in, we have different protocol that we can do. And then once the CDC passed their declaration, we've had a few tenants that most of our properties that will sign it. And now that it's becoming into January, it'll be interesting to see if they extend the moratorium or what happens. But from a underwriting perspective, we became a lot more conservative in year one and year two. From a lot of the research I did, people thought by 2023, rent growth will be back to where it was probably pre-COVID, and maybe even exceeding that. It's been really interesting because, like we were kind of mentioning earlier, pricing in real estate went up since COVID happened. The Fed came out and said they aren't raising interest rates at least till 2024. That might change with a new president coming in, but since the Fed is a separate and not part of the government, hopefully they stick to their word. With the interest rate so low, more deals penciled out last year than they've ever penciled out before. And you would think that'd be complete inverse. And I was pretty aggressive and submitted quite a few offers last year. We got one that we're actually closing on Wednesday in Atlanta, but I think we just took a step back and tried to make sure from an underwriting perspective, are we being conservative? Because in the past, I've yet to buy an acquisition in Dallas, and it's always been because I've been way too conservative. And I've been talking with my partners, and if we continue to underwrite the way we do, we'll never get a deal in Dallas. I was looking at a 1964 vintage unit property yesterday. That's trading a 4.2 cap, and almost all the work has been done on it, which is
exactly insane. We're seeing the same thing. It's so how do you for us, conservative investors, like we value properties based off of what they did, not what they're going to do. Yeah. And when you look at these primary markets, you're looking at it, and it's like you're just guessing. Like I just feel like I'm just guessing. Like I'm just not smart enough. I don't have the software to predict like what Dallas is going to look like in 3 years. So I'm like, I'm just guessing. Yeah, for sure. Put in 4%. Whatever growth rates. Escalator. Sure, why not? Put in 5%, right? It's like, so I usually don't. I usually keep it at that 2 range. But like, and that gives credence to more of like why new developments, because you're buying like you said, 1960s, 1970s C caps with everything already extracted out of it at a 5 or whatever sub 5 cap in these primary markets, and it's like, well, new developments like not that much more, and you're getting a brand new building, in the suburb or whatever. So yeah, we're kind of getting those conversations internally as well. So, sorry to cut you off, but how are you handling that? Like, as you see that, like,
Yeah, no, it's, you hit the nail on the head. I have this internal conversation almost every day, and I've talked to a couple partners, and, one guy that I've been looking with deals with, and we're closing on this Atlanta deal together. We've almost just outlawed Dallas now. I mean, I would love to buy there. I live here, but it's going to be almost impossible. And I think the secondary, tertiary markets, you still have more upside and a little bit more cash flow because the cap rates are higher, but it's tough. And people that were investing 2-3 years ago, where they were seeing 200 to 300% return in 2 or 3 years, I think those days are long gone. And investor expectations, I think, are starting to shift a little bit, but I can guarantee if I take a deal out that shows a 10% IRR, nobody's going to want to invest in it. So it's hard. And with development, I mean, we're building now cheaper than what you can buy 1980s deal in Dallas for. And the expense ratios are a lot lower. Once you get it leased up, it's going to be a lot easier to maintain, and you get probably a better quality tenant. So I love development for those reasons. But it does take, it's delayed gratification, because it does take a really long time from just starting of the planning and zoning process to opening up the asset. So, luckily for ourselves, most of our investors understand that, but you still have to train some of them. Some of the new investors we've had, it's been difficult because they didn't quite know it's going to be this long of a process, and they question. And like, I had a conversation with one of them, and she's like, I was expecting cash flow this year. And I'm like, I'm sorry, it's just a process. And like, through that, the city comes back and gives you different things. And like, at one point they were promising they were going to pay for literally 600 feet of yard or of concrete per road. And they came back and said, we don't have the funds for it. So we had to come up with additional $500,000. And it's just, there's a lot of different nuances with development that you don't have in multifamily, but where pricing's at, and especially the primary market, I think development's the way to go.
Got it. So 600 feet of road costs $500,000. That's what we got. Yep. That's
and they almost made us put in there's a 4-way intersection. We almost had to put in a light, and it was going to cost us over $1 million. And we pushed back, and we're like, that's going to completely destroy the budget. And luckily they agreed to put it in, and they used other funds from other revenue streams. But if they would have said you have to do it, that would have it wouldn't have killed the project, but the numbers would have hurt significantly.
Seems like you need like a politician on your team. Like, send in Bob. Go talk to the mayor. You got to go talk to the council.
It's funny you say that. I have my real estate license, and I house it at Keller Williams. I don't really do anything with it, but I've met a lady at our office who she worked out of Austin. She was a politician in Austin, and we're thinking about bringing her in to help with the new developments. And it just takes one piece off of our plate, and she's a lot better at the political game than we are.
Yeah, you need to have somebody that knows the jargon, knows the motivations and the what's not being said, but between the lines kind of conversations. Because I'm very much like oblivious, right, to that kind of stuff. Like they say one thing, but they can mean something completely different, and you have to kind of decipher food and read between the lines, or having somebody that can see the whole picture and spend there on the other side of that table.
Sounds like something I would enjoy.
Yeah, right.
Politicking.
Yeah, do it. We'll keep you on that. We'll put you in that seat.
Let's do it.
Well, that's a ton of information. So yeah, we're kind of top of the hour. So Matt, back to you. My questions are done.
Great. Sam, I'm going to hit a fire round. So I'm just going to run through some questions. You can answer as short or as long as you want to. And we'll just run down the list. So we've already talked a little bit about books, but what's the best book that you recommend other than Rich Dad Poor Dad?
I'll say two. The book that's had probably the biggest impact on my life, not just real estate, but was Miracle Morning. I was a night owl. I hated waking up early, and it's pretty much transformed I won't say my day, but it's definitely transformed how I look at a lot of aspects of my life. And he has the acronym SAVERS, which is silence, affirmation, visualization, exercise, read, and scribe. And before I read the book, I would exercise, and that's about it. But adding those other 5 components, it's helped me significantly throughout my life. And then there's another one called The Success Principles by Jack Canfield. And I thought it was phenomenal. I listened to a lot of audiobooks, and it was like 21 hours, but I would listen to it and then write notes. And I mean, I can go back through the notes and it's like I'm reading the book again. So those I 2 highly recommend.
Okay. Yeah, Vince was just holding up the Miracle Morning.
I got it right next to my bed right now. I got the newer one, the Dave Osborne collaboration one. It's a little bit geared more toward, so it's the savers and all the Hal Elrod stuff with like excerpts with David Osborne about real estate and money making and things like that. So
nice. I'm actually reading right now one of Dave's books, Wealth Can't Wait. So it'd be interesting to go back through and read that one and see how they played off each other.
Yeah, it's good. I enjoy so far. 2 days into it, but it's good. Good refresher.
All right. What is your superpower?
The first thing that pops into mind hearing this question is, as a kid growing up in the 80s, I was mesmerized by sports. And I feel like I could remember any stat, any player for any team in football, baseball, or basketball. And just from early on through now, I have an affinity for numbers. I don't like math, but I love numbers. And I would say, I guess that's my superpower, just like seeing numbers once, or an address once, or phone number, or property once, and I can remember it for the rest of my life.
I always wanted to be one of those kids that can remember stats. It was people like you that made me feel like a fraud. Like, oh, I'm a Falcons fan. Like, yeah, well, who was the left tackle in 1984 in the 6th week against what team? I'm like, okay, I don't know that. Maybe I'm not a fan.
Well, you can still be a fan without knowing every detail.
Yeah, I agree.
But it was Jack Osborne, you idiot. Made that up. I have no idea who it was.
Yeah, I don't think it was Jack Osborne. What's the biggest lesson that you've learned over your career?
Fell fast. I feel like the biggest failures in my life I've learned the most from. Like at that first consulting job, I was actually laid off of it. I was miserable at the job, and I was basically staying on because a lot of your salary is based on bonuses and on contingency projects, and like how much money you save the client, you get so much. And I was waiting for 2 large bonuses, and I was laid off partly because of the oil and gas recession, partly because I just wasn't a good fit. And that I realized through that I was basically going through the motions, and I was working a lot, but I was given a half-ass effort. And through that, I've learned to commit wholeheartedly to anything I do. And also, when you fail, if you actually go back and analyze and kind of reflect on why you failed, I think you can take significant dividends from it.
Okay, yeah, good points. And then last one here, for the busy working professional who's working towards financial freedom. Maybe they're stuck in a job they're afraid to get out of, or they want to do more than just the 401k. What advice or tips do you have for them?
I think it's taking massive action, referencing Grant Cardone, but also making it quantifiable and setting goals. Like for, I don't know, 4 or 5 years, I always had the plan of getting out of corporate America and going off on my own into real estate. But I was scared. I listened to a lot of outside influences saying, you have a good job, you make 100, just stick to it. And I think if I would have took massive action where I would have pulled the ripcord and just quit, I would have succeeded a lot earlier than I did. And by setting those quantifiable goals, you have milestones, whether it's each week, each month, each quarter, each year, whatever you determine those goals to be, you can measure them. And I think if you have measured goals, it's a lot easier to get somewhere than whether you just have a kind of a path without no business plan. And obviously business plans change and your goals can change in a heartbeat or any second. But if you have a path, you can at least chart your progress.
Yeah.
I want to jump in real quick. So you definitely said something that reminded me of Elon Musk so when that was your first job you're talking about, like your first job out of college?
Well, I had 4 jobs outside of grad school that spanned 10 years or so, 12 years, something like that. And basically 6 weeks into the first job, I knew I wanted to work for myself. Yeah. But I always came up with reasons not to quit, and always came up with reasons that I just need to make X number and then I'll feel safe, or I need to buy another property and I'll feel safe. And it was always, yeah, it was like, if I have this much more cash flow, I'll feel safe. And I finally realized that you can't have the perfect time. And if you do go out and fail, I could always go back, or I could always start another venture, whatever. But I've been passionate about real estate for years. I love it. And I think that's also something that a young 20-year-old self should know is real estate can be great. It can create a lot of wealth, but you need to be passionate about it. If you don't enjoy it, it can be a beating. Like, I used to think it was my hobby. It's definitely a job, and I love it. But when you're working 50, 60, 70 hours a week, you need to love it. And if you don't, you're going to burn out.
Absolutely. And so the thing I'm drilling on and I'm going to highlight here, because you said it a couple of times, or synonyms to it, was things like, feeling safe and, taking risk and being scared, right? Those are some of the words that stuck out with me. And so I do a lot of like mentoring of, younger people, like, 20 to 25 years old. And I keep hearing these same things. I'm like, what are you scared of? Like, you literally have youth on your side. Like, you can fail. It's okay. Yeah. You can recover. But they're acting like they're, 70 years old. And if they fail, then they're, going to die homeless in a shelter somewhere because they don't have anything left. I'm like, you can take risk, and take massive action in something you're passionate about. And if you fail, that's fine. Because you have youth on your side. You can just pick yourself back up. You got a strong back. You got a lot of energy still. You probably don't have kids and, family and obligations yet. But people are still, they're so risk adverse. And it blows my mind. So I try to get through them. Like, you can fail. It's okay. Just learn the lesson and move on. And Elon Musk definitely drilled that into kind of my head with his talks and his book of younger generations are so scared to do anything because they're afraid of failure. They're afraid of, whatever. But at some point you just got to burn the ship and, jump in the water and swim. So that's a good point that you had that moment and you're like, okay, these corporate jobs aren't for me. I need to, jump off the cliff or jump off the ship or whatever analogy you want to use.
Yeah, I completely Oh, go ahead.
No, you go ahead. So I was going to move on. So.
I'll let you move on.
Okay, I misspoke. We have one more question that I wanted to ask that we're kind of starting to weave in here. Who do you think that we should have on the show? Who would you like to see come on the Cash Flow Project, or maybe someone you could introduce us to that you think would be good on the show?
I mean, I think luckily I've built out a network where I have a lot of great people that I could recommend. A couple that come just top of mind because I talked to him yesterday. But there's one of my partners, his name is Michael Walkup, and he's been successful in business and real estate. Just everything he does it with ease. And I think he's just successful in life. And then another guy who I've got to know over the last couple of years, he's a great guy. He's a mortgage broker. He's helped finance one of our deals, and we'll probably do more in the future. His name's Carl Pankratz, and we've become really good friends. And he's a mortgage broker, but he's also an attorney. He's worked on city councils. He just has a wealth of knowledge that he can share with your audience.
Awesome. I know that sounds like they'd be some pretty interesting guys to speak with. So lastly, we're gonna punt the ball back to you. Do you have any requests for our audience? And then likewise, how could they reach out to you if they want to know more about things that you're working on, or just to get in touch with you?
Yeah, you can. I'd love to help people, especially if they're getting into business. You can reach out to me and call me at 972-855-7654 or email me at sam@trinitycapitaltexas.com. I know real estate can be a very overwhelming world and industry, and there's so much information. And it's good to, at least for myself, to kind of focus and narrow down to not chase the shiny penny everywhere. So if they want just some advice or to talk about a situation or scenario, I'd be glad to help them. So
Sam, it was great to have you on the show. We always enjoy talking about high-level players, or talking with high-level players such as yourself. Tri-City Equity Group is got an interest in the new development, so glad to reach out to you and be able to have this discussion. But for everybody who's listening, if you're interested with us, you can go to tricityequity.com to learn more. And if you're interested in connecting with some like-minded investors, we have the Facebook group, which is the Honolulu Multifamily and More. And if you found value in today's podcast, please subscribe and give us a review on Apple Podcasts or Spotify. And if you know anyone who might resonate with today's podcast or wants to connect with Sam, share the episode with them. Reach out to Sam, reach out to us. Like always, we're always willing to help anyone that's interested and wants to listen. And that's all we got. So we'll see you next time. Thanks for coming on, Sam.
Thank you, Matt and Vince. I loved it, and I hope I added value to you and your listeners, and look forward to talking to you soon.
Awesome.